This video is not a biography. It is not another top 10 quotes montage dressed up in stock footage and dramatic piano music. This is about 7 rules that have quietly generated more durable wealth than any trading strategy, any crypto scheme, any high-frequency algorithm on Wall Street. 7 rules that the most successful investment operation in human history has followed without deviation for 60 years. And here is the part that should concern you. These rules were never secret. They were published in plain English every single year. Hundreds of millions of people had access to them. Almost none of them used them. Why? Because they require something most investors refuse to supply: patience and the willingness to think differently from the crowd. That is exactly what this video is going to force you to do. Or if it sounds like something you're interested in, hit that subscribe button. Most people think investing is about picking the right stock at the right time. They treat the market like a casino. Hot tips, momentum trades, technical patterns, quarterly earnings plays. They are not wrong to want returns. They are wrong about the mechanism that produces them. The Buffett doctrine does not describe investing as prediction. It describes investing as thermodynamics. Specifically, the principle of entropy arbitrage, the gap between perceived disorder and actual underlying order in a system. In every market cycle, Mr. Market, the famously irrational emotional entity that Benjamin Graham named, introduces maximum perceived chaos. Prices scatter. Fear amplifies every signal. That is entropy, visible on a price chart. But underneath the noise, certain businesses maintain what analysts call a structural advantage, a durable competitive position that does not erode with sentiment. The gap between the price entropy creates and the value thermodynamics preserves is where all real wealth is generated. Call this the invisible architecture. It is the structural framework underneath every great investment Berkshire Hathaway has ever made. It does not appear on a candlestick chart. It does not trigger a scanner alert. It shows up only when you know the 7 rules that reveal it. Consider a real suspension bridge, the kind that carries 50,000 vehicles per day across a major river. The engineers who designed it did not guess at the load capacity. They did not say, "Looks strong enough." They calculated a specific number, the maximum design load. Then they built the bridge to handle 3 to 4 times that load. The difference between what the bridge will carry and what it is designed to handle is called the structural margin. Now here is what is interesting. That margin, that invisible buffer between performance and failure, is precisely why bridges built in the 1880s still carry 21st century traffic. The designers did not know what future loads would look like, so they built in protection. This is exactly what happens to every investor who does not understand the Buffett doctrine. They build bridges to precise spec. No margin, no buffer. They calculate exactly what a stock needs to do to justify its current price, and then they buy it. One deviation, 1 quarter of bad earnings, 1 interest rate adjustment, 1 supply chain disruption, and the load exceeds the design spec. The bridge fails. The position collapses. The investor calls it bad luck. It was not bad luck. It was the absence of structural margin. It is rule number 1 of 7. And without it, the other 6 rules do not matter. Here is what the absence of this architecture actually costs. The average retail investor in the United States underperforms the S&P 500 by approximately 1.5 percentage points per year, according to Dalbar's quantitative analysis of investor behavior, a study conducted annually for over 30 years. On a $50,000 starting portfolio compounded over 30 years, that 1.5-point annual shortfall is not a minor inconvenience. It is the difference between $432,000 and $574,000. $142,000 gone. not lost in a crash. Eroded quietly, one bad decision at a time. But that is the visible cost. The hidden cost is worse. Every time an investor panic sells a position, and the data shows that retail investors time these exits with remarkable precision for maximum damage, they do not just lock in a loss, they exit the market, they sit in cash, they miss the recovery. The 3 best trading days in any given year account for roughly 75% of annual returns. The average retail investor misses them because they were managing their fear, not their portfolio. And the hidden cost of that hidden cost is psychological. Investors who lose money repeatedly do not become more disciplined. They become more impulsive. They chase the next story, the next hot sector, the next recovery play. They are not being irrational. They are following the incentive structure the system has built for them. Every broker, every financial media outlet, every algorithmic feed profits from their activity, not their performance. The trap has a name. Analysts call it the behavior gap, the measurable difference between what investments return and what investors actually receive because of when they enter and exit. The loop self-reinforces, the penalty compounds, and the most damaging part is not the lost money, it is the lost time, because in compounding, time is not replaceable. Now we enter the first rule. This one is called the threshold. Most people think the margin of safety means buying cheap stocks. They hear the phrase and picture discount retailers, beaten down companies, low PE ratios, 52-week lows. That is not wrong, or it is incomplete. Benjamin Graham, the Columbia professor who codified this principle in his 1949 text, The Intelligent Investor, defined the margin of safety with unusual precision. It is not about price alone. It is about the gap between price and intrinsic value. And intrinsic value is not the same as book value, earnings, or any single metric. Graham found that portfolios maintaining a 33% or greater discount to intrinsic value produced returns that were statistically distinguishable from random chance in the investor's favor. Below 33%, the results became indistinguishable from market randomness. That threshold, 1/3 discount minimum, is the dividing line between investing and gambling dressed in a suit. Think of it this way. Imagine 2 investors buying the same company. Investor A pays $100 for a business worth $100. Investor B pays $65 for the same business. Both get the same underlying value. But Investor B now has a 35% buffer, a structural margin. If the company underperforms by 20%, Investor A is underwater. Investor B is still positive. The buffer did not improve the business, it improved the investor's position inside the relationship. This is the mathematics of structural protection. It does not feel exciting, it does not generate content, but it is the reason the Berkshire Hathaway model survived the 2000 dot-com collapse, the 2008 financial crisis, and the 2020 pandemic without a single forced exit. So how do we apply this loop? Start here. Before any position, calculate your estimate of intrinsic value, conservatively, and then demand a minimum 30% discount to that number as your entry point. Not 15%, not 20%, 30%. This is not a preference, it is the threshold. This single filter, applied consistently, eliminates the majority of decisions that produce permanent capital loss. It is not a guarantee of profit, it is a guarantee of structural protection. And in investing, protection is the first form of performance. We move into the second rule. This is called the fortress. Most people think competitive advantage is about being good at something. Best product, best service, biggest market share. That sounds right. It is incomplete. The term economic moat was popularized by Warren Buffett's shareholder letters over decades of annual writing. Morningstar later institutionalized it as a formal analytical framework. Their research, published across thousands of company assessments, identified 4 structural sources of durable competitive advantage: cost advantages that cannot be replicated at scale, switching costs that trap customers in a relationship more expensive to exit than to maintain, network effects where each additional user increases the value of the system for all other users, and intangible assets, patents, regulatory licenses, brand identity, that are legally or structurally protected from competition. Companies possessing 2 or more of these mechanisms showed a median return on invested capital of 15% or greater over rolling 10-year periods versus 9% for companies with none. That is not a small difference. Compounded over 20 years, it is the difference between a business that doubles twice and one that doubles 4 times. Consider 2 toll bridges, a favorite Buffett analogy. Each one bridge crosses a minor river in a mid-sized town. Someone could theoretically build a second bridge. The other bridge is the only crossing for 60 miles in either direction, connecting 2 major population centers. Both are toll bridges. One has a moat, one has a ditch. The difference is not the business model, it is the structural defensibility of the position. So how do we break this loop? Before any investment, run the moat audit. Identify which of the 4 moat types, if any, this business possesses. If you cannot name at least one specific, demonstrable source of structural advantage, not "they are well known" or "people like them," but a specific mechanism, move on. A wide moat is not a nice to have. According to research into Berkshire's portfolio construction, and it is the single variable most correlated with the long-duration performance that the strategy depends on. The fortress only holds if the walls are structural, not cosmetic. The third rule is called Temperament Tax. Most people think market volatility is the problem. When prices fall, the common instinct is that something has gone wrong. The market is broken. The economy is in trouble. The investment thesis has failed. The Buffett doctrine describes the opposite mechanism. Benjamin Graham's allegory of Mr. Market, introduced in Chapter 8 of The Intelligent Investor, describes the market as a business partner with severe mood disorder. Some days, Mr. Market arrives at your door in a euphoric state, offering to buy your share of the business at an absurdly high price. Other days, he arrives in despair, offering to sell you his share at a panicked discount. The critical insight: you are never obligated to transact. You can simply observe his mood, use his price when it benefits you, and ignore him entirely when it does not. Daniel Kahneman and Amos Tversky's Landmark, 1979. Prospect theory research found that humans experience losses psychologically at roughly 2.5 times the intensity of equivalent gains. That asymmetry is the temperament tax. Investors who have not internalized the Mr. Market protocol pay this tax every cycle. They sell in despair because loss feels unbearably large. They buy in euphoria because the fear of missing out overrides the discipline of valuation. They systematically do the opposite of what the margin of safety requires. And imagine 2 investors, call them patient and reactive, holding identical positions in a great business. The market drops 30% in a single quarter. Patient reviews the fundamentals. The moat is intact. The earnings power is unchanged. The intrinsic value estimate is approximately the same as before. Patient adds to the position. Reactive feels the 2.5 times loss, asymmetry, sells, and locks in the loss. 18 months later, the price has recovered and exceeded the prior high. Reactive has missed the entire recovery. Patient has compounded through it, Same business, same event. Entirely different outcomes, produced entirely by temperament, not analysis. The protocol. Build a pre-commitment rule. Define in advance, before the position, not during the panic, the specific conditions under which you would exit. Not a price decline, but not a news event. A fundamental change, moat erosion, management integrity failure, intrinsic value revision downward. Anything else is Mr. Market's mood. Transact on fundamentals, never on sentiment. This fourth rule is called the perimeter. Most people think competence in investing means knowing a lot, reading widely, following many sectors, staying informed across technology, healthcare, energy, finance, consumer goods. The more you know, the better you invest. That sounds logical. Research into Berkshire Hathaway's portfolio history tells a different story. Between 1965 and 2024, the firm generated its extraordinary compound returns, approximately 19.8% annually versus 10.2% for the S&P 500, from a remarkably narrow set of industries. Consumer brands, insurance, banking, railroads, energy infrastructure, not semiconductors, not biotech, not speculative technology platforms. The Buffett principle here is explicit. The size of your circle of competence matters far less than knowing precisely where its boundary is. Philip Tetlock's 20-year research project on expert forecasting, documented in his book Super Forecasters, found that specialists who made confident predictions outside their core domain of expertise performed worse than chance. Not as well as generalists, worse than random. The confidence generated by broad knowledge created the illusion of competence without the substance. This is the perimeter problem. Investors who do not know where their edge ends behave as if it extends everywhere. The protocol is simple and uncomfortable. Map your competence with brutal honesty. For every industry you believe you understand, answer 3 questions. Or can you identify the key drivers of long-term value in this business? Can you model a downside scenario with specific mechanism? Can you name the conditions that would destroy the moat? If you cannot answer all 3 with specificity, you are outside the perimeter. Acknowledging that boundary is not a limitation. It is a structural advantage. Investors operating within their circle of competence make better decisions with less information than those operating outside it with more. The 5th rule is called the real number. Most people look at reported earnings per share. It is on every financial summary, every analyst report, every earnings call headline. EPS, clean, simple, quarterly. The Buffett doctrine describes reported earnings as accounting's best effort and an investor's worst guide. Or in the 1986 Berkshire Hathaway shareholder letter, the concept of owner earnings was defined with notable precision. Take reported net earnings, add back depreciation and amortization as non-cash charges. Then subtract the capital expenditures required to maintain, not grow, but merely maintain, the competitive position and volume of the business. The result is the actual cash the business produces for the owner. This number is frequently and substantially different from the reported figure. Consider 2 businesses, both reporting $10 million in annual net income. Business A requires $8 million in annual capital expenditures just to maintain its equipment and market position. Its owner earnings are $2 million. Business B has no meaningful maintenance capex. It operates on intellectual property and brand. Its owner earnings are approximately equal to its reported earnings. Standard valuation methods would treat these businesses identically. Owner earnings reveals that one is 5 times more valuable than the other per dollar of reported profit. How to apply this? Before any valuation, calculate owner earnings. Use the simple formula: net income plus depreciation and amortization minus maintenance capital expenditure. And treat that number, not EPS, as the basis of your intrinsic value estimate. This single substitution changes the analysis of capital-intensive businesses entirely. It is the filter that separates real earnings power from accounting theatre. The sixth rule is called the character audit. Most people evaluate management on results: revenue growth, margin expansion, stock price performance. If the numbers are good, the management is good. That is the standard framework. Research into Berkshire Hathaway's acquisition history reveals a different hierarchy. In multiple shareholder letters, the evaluation framework for management begins not with competence, but with integrity. The specific formulation, a manager who is highly capable but lacks integrity, is more dangerous than one who has both limited competence and high integrity. A capable person with compromised character has more tools to do damage. This is not a soft preference. It is a structural risk assessment. Jim Collins's research for Good to Great, which studied 1,435 Fortune 500 companies over 40 years, found that the defining characteristic of leaders who delivered sustained exceptional performance was not charisma, not vision, not technical brilliance. It was a combination of fierce professional will and personal humility. Specifically, the habit of attributing success to the team and failure to themselves. Leaders who inverted this pattern, crediting themselves for success and blaming external factors for failure, correlated with companies that reverted to average performance within 10 years of any peak. The character audit. Read 5 years of annual reports for any company you are considering. Pay attention specifically to how management describes both successes and failures. Do they acknowledge mistakes explicitly? Do they take personal accountability? Do they describe the business's competitive position honestly? Or do they frame every challenge as an industry-wide phenomenon beyond anyone's control? As capital allocation decisions are the clearest window into character. Does management repurchase shares when they are cheap or when it is fashionable? Do they make acquisitions that build the business or that expand their own empire? Integrity is not invisible. It leaves evidence in every decision. The final rule is called the time leverage. Most people think long-term investing means holding for 3 to 5 years, maybe through a full market cycle, patient by most retail standards. The Buffett doctrine describes a different duration. The operational principle embedded in Berkshire's holding history is expressed most clearly in the documented holding periods of its core positions. Coca-Cola, held since 1988. American Express, held since 1964 in various forms. Geico, relationship beginning in 1951. These are not trades that worked out well. They are structural commitments to compounding engines. Albert Einstein is often credited, perhaps apocryphal but mathematically precise, with calling compound interest the eighth wonder of the world. Here is the mathematics that makes the duration mandate non-negotiable. A $10,000 investment compounding at 15% annually, approximately the Berkshire long-run rate, produces $163,665 in 20 years. Extend that to 40 years, and the result is $2,678,635. The final 20 years add $2.5 million to the $163,000 produced in the first 20. The exponential curve does not become dramatic until the final third of its duration. Investors who exit at year 20 have captured roughly 6% of the total 40-year return. They left 94% on the table. The long-duration mandate requires only one thing: that you buy right enough, using the previous 6 rules, that holding requires no action. If the moat is intact, if management integrity is confirmed, if owner earnings continue to compound, if the margin of safety protected your entry, then the primary action is inaction. The most expensive activity in long-duration compounding is activity. Transaction costs, tax events, and behavioral drift all extract from the machine. The mandate: hold until a fundamental rule is violated. Not until boredom strikes, not until a better story emerges, not until the market offers a higher price, until the fundamental architecture changes. 7 rules, 1 system. Let us compress. The threshold: demand a 30% minimum discount to intrinsic value before any entry. This is structural protection, not pessimism. The fortress: identify at least one specific, demonstrable moat mechanism before any commitment. The wall must be structural, not cosmetic. The temperament tax: build pre-commitment exit rules before the position, not during the panic. Transact on fundamentals, never on sentiment. The perimeter: map your circle of competence honestly and refuse to operate outside it. The boundary is a structural advantage. The real number: base every valuation on owner earnings, not EPS. Accounting is a starting point, not a conclusion. The character audit: read 5 years of annual reports before trusting capital to any management team. Integrity leaves evidence. The time leverage: hold until a fundamental rule is violated. Inaction is the most powerful action in compounding. These are not separate rules. They are a single interconnected architecture. Violate one and the others lose structural integrity. Here is what all of this actually means at a deeper level. The market is not your opponent. It never was. The market is a mirror, an amplified, noisy, emotionally unstable mirror that reflects collective human psychology at every moment. Sometimes it shows you a wildly distorted image. Sometimes it shows you something surprisingly accurate. Your job is not to beat the mirror. Your job is to know yourself clearly enough that the distortion does not move you. See you in the like video. Don't forget to like and subscribe if you gained value.